Hi, and welcome to another FSCJ educational video. Today, we start a series of videos covering the fundamentals of accounting.
This video is going to deal with a very important topic for most retail establishments, and that is the cost flow of inventory. We're going to use a very difficult example of accounting for inventory. We're going to use fungible goods.
Fungible goods cannot be distinguished from the individual units. For example, if you owned a gas station and kept buying and selling gas at different times, you wouldn't be able to tell 1 gallon that's pumped out from another.
We're going to account for the flow of unleaded gasoline through our service station in our first month of operation.
So, let's look at how we account for this. And for example, we'll start in January.
So on January the 1st, we're going to start out with 0 gallons. And then on January the 2nd, we are going to purchase 10,000 gallons at $2 cost per gallon.
On the 10th of January, we're running low and purchase 8,000 gallons, but at $2.10 per gallon.
And on the 16th of January, we're going to purchase another 6,000 gallons at $2.05. And on January the 23rd, we're going to have an additional purchase of 8,000 gallons at $2 per gallon.
So this means in just our first month, we've purchased 32,000 gallons of gasoline. That's all been mixed together at different price points.
Now the question is, how many gallons did we sell?
We go out and we measure what's left. Turns out we still have 2,000 gallons left. So we've sold 30,000 gallons of our 32,000 gallons, and we can't possibly know what the price of each of the gallons we sold are. Therefore, we used cost flow assumption to help us.
Now, when we're trying to decide which cost flow assumption we're going to use, we have 3 at our disposal. We can use FIFO, which means first in, first out. In other words, we're selling the oldest gallons first. We can use LIFO, last in, first out, which means that we're selling the newest stuff first. Or we can just average it out using a weighted average cost flow assumption.
So if we use the FIFO assumption, then we've sold the oldest stuff first. That means the units remaining will be the last stuff we purchased.
Well, our last 2,000 gallons were purchased at $2 per gallon. So our ending inventory, that is the amount that we have on hand at the end of the month, would be 2,000 gallons at $2 per gallon,
giving us $4,000 in the ending inventory. Thank you for watching this FSCJ video, and make sure you watch the LIFO and weighted average videos in this series.